investor update. I'm going to be sharing the slides here in just a second, but I can tell you I am incredibly excited for the conversation today. One, because we've got some catch up on market issues, because I've had a number of great conversations with you, many of you, and some that are going to be joining us for the first time to have this conversation, to update you on market issues and what's going on. And then secondly, because I am very excited about some many new features that we'll be bringing to each of you going forward here. So let me go ahead and pull up my screen. I had a little bit of tech problem here. It's part of the process of working with tech, you know. Let me share. There we go. All right. Technology, you gotta love it. All right. So as always, this is your financial journey, and we take time each month to update you on market issues and economic issues, planning issues, wealth management issues, risk mitigation issues, tax strategies, everything that is critical to helping you to create, grow, protect, and preserve your family's wealth in today's economy. And this investor update for the month of May is no different. We're going to be doing exactly the same thing here. Why is that doing that thing? There we go. Okay. So with that in mind, as always, the disclosures, I take a few minutes just to remind you that everything we talk about here is designed to cover a broad range of people. There could be tax issues that may not make sense for you or may be perfect for you. Same thing's true with estate design issues or with investment strategies. Depending upon your needs, your investment goals, etc. Maybe some of the items we'll touch on here will not fit you. So that's why everything that we discuss has to be viewed from what your needs are. We also are more than happy, I am more than happy to talk with your team, which could include your accountant, could include your attorney, your banker, whatever it takes that we can help you with to grow wealth, to create wealth, grow it, protect it, and preserve it. That's what this is about. And so anything we talk about, just keep in mind that all of you are different. Your situations are completely different. So make sure that you have reviewed this from the viewpoint of your needs for you and your family and your goals to make sure this makes sense for you. So with that in mind, as always, there'll be a chance for questions. You can either do an online chat if you'd like to, or you can raise your hand. And for some of you, if you'd like to actually ask your question out loud, you are welcome to do so. So we'd be happy to do that as well. So what we're going to talk about tonight is what we believe so far, which is kind of what we've been talking about the last probably 3 to 4 months. We're going to talk about the good, the bad, and the ugly, because I know that many of you are concerned right now. We're going to take a quick look at market and economic review, potential exit strategies when we have a recession, whether that's now or in the future, portfolio management diversification options, so that if you want to take advantage or take action sooner, I'm more than happy to have that conversation with you. And as I say to you all, you're the boss, I'm the employee. And so what if you feel like we need to pull back sooner rather than later, we're going to touch on that in number 5. Next, number 6, part of what I'm very excited about is our new website and educational programs, which I'm going to share with you, as well as how that ties into the wealth management applications, your questions, and then reminding you the next investor update. So with that in mind, let me go ahead and move forward. The review of what we believe so far, as we have talked, and I'm not going to spend a huge amount of energy on it. In previous webinars, we've certainly covered this. What is fundamental analysis? That's determining whether we should invest in a security, or we should invest in an index, or whether we should invest in an industry, or certain types of programs. It determines whether we should or not. Are they solid? Are they strong? Do we feel comfortable or good with them as a management team and their finances? That's what fundamental analysis tells us. Technical analysis talks about whether we should do it today or not. Because while some company may be strong, some index or some industry may be strong, it may not be the right time now, because we want to invest not in a day trading mentality. I don't have that mentality, but rather in a trend trade using the cycles at the peak and the trough. So technical analysis helps us identify if we're on target to do that at this point. What is a correction? A correction is a 10% down in the market. It happens. It happens off of volatility. It can happen off of something else, major economic or geopolitical issues as well. But a correction is typically something that's happening more short term. A bear market, that's a 20% or more downturn, typically comes off of a recession. Doesn't have to be. We can certainly, and have had plenty of times where we've had a bear market that has hit and lasted for a short term, but typically a bear market in its normal behavior is 20% or more down and held for at least a couple of quarters. Volatility is that up and down experience that you see in the markets. And I know that right at this point in time, many of the people that I'm talking with, they see volatility as something much worse, much more aggressive, and it has to do more with their psychology of the market, more of political issues and various pieces that cause you to have concern that it might not be volatility, it could be something far worse. And what is recession? A recession is defined several different ways, but typically, historically, it's been defined as 2 quarters of negative GDP growth. We have not had that yet. And during the pandemic, we had basically 1 quarter, 2, depending on calculations, but it was very short-lived. And at this point in time, the first quarter of 2022 did come off negative. It was barely negative, but it was negative. And we're waiting to see what the restatement does. Does it stay negative, or is it just going to be barely positive? Again, may not really matter. It could be that we're in a recession right now, but I don't think so. And we're going to talk about that as well. Overall, though, what my goal is in this evening is not to spend all the detail that I spent in a lot of different times going over all of these facts. I did that in the last few updates to just kind of put you up to speed, to give you the information you need to make good decisions. Tonight, I want to spend a little bit of time talking in more detail about some of the key things that make me think that we might not be there yet, and then more importantly, to help you understand how we operate here at when it comes to managing portfolios for entry and exit strategies. So that's what we're going to take some time to talk about this evening. So that's what we believe so far. I'd like to also remind you that the question of, are we having a recession this year or next year? I think probably there's a lot more conversation that it's going to be sooner rather than later. You may remember that in last month's update, I had 2024 in there. I think the reality is that we're probably thinking it's not going to be that far out. But that's not the end of the world. I also made the joke, although it's not, that from Forbes Online, there was a time back in the Wall Street Journal where they put this headline there: the stock market has predicted 9 of the past 5 recessions. And that actually comes from Keynesian Paul Samuelson, who joked about the market's inability to actually identify recessions. But then sort of his antithesis, Robert Bartley, completed the thought and said, well, Washington got the message and mended its ways in time so that the other 4 recessions didn't happen. Yeah, maybe that's the possibility. I think probably many people on both sides of the aisle tend to wonder whether this current administration has the ability to do that sort of thing. So the real question is, what are we looking at? And even if they don't have the ability, is it totally on Washington or leadership's viewpoint to stop a recession, or are there other factors that have impact on it? So we're going to take a look at a little more detail tonight to identify some aspects of that. As I would always remind you, there's 4 primary engines of economic growth. There's lots of lagging indicators that we look at to try to measure what's going on, but the leading indicators are GDP growth, business profitability, unemployment rates, and interest rates. The GDP growth, as I mentioned a moment ago, was negative for Q1 of 2022. Again, if it gets restated, that might change, but I think it's going to be flat or slightly negative when it's all said and done. Business profitability, I've identified as a plus right now. I'm going to show you why I say that tonight, because that's one of the engines that keeps the plane flying. Unemployment rates certainly are low now. And while it may be a question of underemployment versus unemployment, the reality is there are plenty of job opportunities out there for those who are interested in working. And then interest rates, I've identified as a plus minus, because while it is a plus minus in the fact that interest rates will be rising, I think that probably there's a lot of question out there of how much interest rates will rise. And then is that a bad thing if they raise interest rates, or could it be a good thing if they raise interest rates? So we're going to talk about that as well. So now, the good, the bad, and the ugly. So I'm going to start with the ugly first, because I think that's the stuff that really is catching people's attention and maybe driving some of the fear that's out there. So number one, the price of oil, up and away. I mean, oil is high, and certainly if you look at one of the primary factors to the economy, fossil fuels are clearly that issue. The fact is that oil is involved in transportation, it's involved in manufacturing, it's involved in many aspects of production. And so the price of oil being high is actually adding to our inflationary problem. I certainly have heard plenty of people say that maybe there is a desire among some to force oil prices high so they can then implement a green agenda. That may be true. That I wouldn't disagree with that sentence, to be honest with you, but I would also say that the American people and probably people of the world probably are not as excited about that concept, especially if green programs really aren't ready and available to implement yet. Number two, unresolved supply chain issues, empty shelves, and Babygate, the formula process, where they're not finding formula and the government's slow reaction to get that process in place. The Babygate may be the thing that quite honestly catches their attention and makes government start to function a little more efficiently, because obviously they haven't. If you follow that story at all, when they close that plant down in February, from February to May, they've left that plant closed, that plant actually created 40% of all of the formula that is used in our nation. Again, that's not the only problem though. Empty shelves, if you've been to your local stores where you shop, we see empty shelves in many aisles. Again, supply chain. And supply chain doesn't necessarily mean the entire thing's broken. What it means is that there is a connectivity, even on the simplest issues. It may be that everything is necessary to put a product out except one component's missing, and that one component stops everything. It's sort of a break in the chain or a choke at the point of departure. The point is that those supply chain issues are unresolved still. They're still not working, and supply, meaning there's low supply but there's higher demand, is forcing prices up because people want what they want. And if they have the money to buy it, and they can, they're going to, even if they have to pay a little bit extra. On the other hand, that supply chain, when it reverses, it has some other positives attached to it. Rising interest rates. I just actually had 2 investor advisor updates today with some of the groups we work with. And all of us agree, the Fed has historically been a day late and a dollar short whenever they raise interest rates or whenever they lower interest rates. They tend to be slow. They tend to be dovish rather than hawkish. And so while those rising interest rates, quite honestly, should have happened over a year ago, the reality is they haven't. And so then the big question now is that going to create a hard landing for the economy, meaning a lot more pain? Or will it not be as problematic, or are there even some good aspects to this? And I would tell you that one of the good aspects, which I'm going to talk about more on the good part of the discussion, is that it shows our economy is growing. Otherwise, they wouldn't need to raise interest rates. If the economy was not growing, if there wasn't a need for supply and demand, they probably wouldn't have to raise interest rates right now. But it's been a long time since they did. And quite honestly, it's a good thing because it does represent an opportunity to reset things, to get things moving forward again. And so that when we have the next serious recession, whether that's now or in the short future, that we're ready for that. And then recession and or potential stagflation. I think that everybody is aware that recession is looming. Again, whether that's current or by the end of this year or next year, I think everybody's aware of that. But I think the word that really scares people, and I hear people say it, is stagflation, because quite honestly, most of us only remember stagflation from the 1970s under the Carter administration. Then Ronald Reagan came in and things began to adjust accordingly. That stagflation was incredibly painful, which means a stagnating economy with inflation at the same time. So then the question becomes, do we have a stagnating economy? And with inflation being like it is that a problem? Is that going to create the same kind of pain we experienced in the 70s? I get it that everybody is thinking about these things, and that would definitely be the ugly, and time will tell whether that's the case or not, but I'm not so certain that's what we're headed for. And I'm going to continue today as well as in the future to show you data that I think speaks differently to it. Again, I'm ready to adjust If new information comes out that makes me think something's different than it is, hopefully by now you know that I'll make those adjustments accordingly. But for now, I'm going to tell you that I'm not so certain that it's quite as definite as what some people would try to say or they would believe. What's the bad? Well, the administration, the current administration's policies. And I'm not going to pull a punch on this. I don't care what letter is by their name, D or R. The reality is the processes I see them operating with is clearly cuckoo for Cocoa Puffs. It does not seem to have much connectivity. I mentioned Babygate and the formula issue. It did not take the FDA 3 months to figure out how to get this plant back open. They could have gotten that open within weeks if they wanted to. Certainly, when I look at Pete Buttigieg and the Secretary Transportation policies he's been operating, which have impacted our supply chain issues, which have impacted the way we're able to get goods, which have impacted many of these pieces that could have been fixed if somebody had been a little more focused, a little more direct, a little more better planned on the process. Jennifer Granholm, Secretary of Energy, her policies and the way that she has handled oil is terrible. Now, she may be enacting what she's been told from the Biden administration or not, but the reality is that had they done several things different, our oil prices wouldn't be as high as they are right now. Having said that, those are the cases that we're experiencing right now with transportation and energy. And so those two issues are contributing a lot to that, which is going to hang on to that thought for a second, because I think that when we get to the good, maybe it'll help make sense of items 1, 2, and 3 on the bad. Mayorkas, Secretary of Homeland Security policies and how they're handling that. The desire to bring in so many people that are not following through the regular immigration process. You say that you want to fix unemployment. Okay, great, let's work on unemployment. But at the same time, with a huge glut of people coming in, and let's assume that these are wonderful people coming in. I realize we hear bad stories, but let's assume for a moment they're wonderful people coming in. They're competing with jobs for Americans, and those jobs are probably not going to be as high paying. So that also is feeding back into this problem. So I think that as we look at these various issues of items 1 through 4, they represent part of the bad, and maybe you would call them the ugly. I think that they're just challenging issues that various administrations, whether they're D or R, have to struggle through and think about. And I've seen both sides do things that I don't agree with, and this case is no different in that way. But I do think that there is some opportunity coming as we go forward. Number 5, discontinued quantitative easing. You may or may not remember the whole discussion about quantitative easing, but quantitative easing is when the government prints more money. It's when it buys back bonds. It represents how they handle interest rates, lowering. Those are items designed to make it so the economy can come back faster. Well, they have discontinued all of it. They're no longer buying back bonds. Now selling bonds. Now they're buying them back. They are actually not their bonds. They're selling government bonds, and they're buying. Is that right? No, they're selling government bonds, and now they're buying back corporate bonds as well. They are changing the balance sheet of the Fed because they are reloading for some time down the road, when rather than use the quantitative easing programs, they feel like the economy is actually strong enough. And I think the inflation is one of those flags that's telling them this time we got to start getting some things different. And so consequently, we've been waiting, and I say that from 2008, we've been waiting for interest rates to really start ticking back up again. And we've seen a few minor examples, but now we're seeing it in maybe a different way. We've waited for the government to stop buying back their bonds and to actually start selling government bonds again. And we've been waiting for them to actually balance out their worksheet with not just government bonds, but actually corporate bonds. And so quantitative easing, which has been probably one of the biggest things that's led to our inflation, is also one of those things that they have stopped completely right now. And I think that speaks to a positive, not a negative. And I think that's important as we go forward here and look at some of the other material I want you to see. So what's the good? Well, go back to what I said about the bad with items 1, 2, 3, and 4. With the current administration plus some of their secretaries of the various cabinet, the 2022 midterm elections are probably going to change a lot. They're probably going to change how everything is being perceived in the markets and the economy and so on. And I would remind you to consider Bill Clinton and Newt Gingrich. Maybe a lot of years, maybe some of you are too young to even remember it. But I remember when Newt Gingrich and the Contract for America came up, and when he and the Republicans, and I'm not saying that R is the right number here or the right letter here. What I am saying is conservatives who had a different mindset about how things work, when they came in, they changed a lot of policies. And I would tell you that I honestly think that they probably saved Bill Clinton's presidency, because the growth that came out of the economy as they began working at it and implementing those 10 steps for the Contract for America, I think that it had a huge impact on how the economy functioned after that. So I would tell you the 2022 midterm elections, I think they're huge. I think that they are going to be a step in the right direction. And just imagine right now, if you're sitting here thinking about, I'm fearful of the markets, I'm concerned about the economy, etc. Just imagine if you had a conservatively led Congress and Senate, that House of Representatives, Senate, the Congress, and you felt like they were actually putting brakes on some of this and actually taking steps to fix things, I think that you would probably have a different feel for where we are today. I do, because I think I would have a different feel if I could see somebody who was putting brakes on bad policy, who was calling and holding people accountable for bad policy. And I think that is going to be a huge impact as we go forward here that you need to be aware of, that it's just a few months away. It's a few months away. I see that some of you have questions and hands up. I'm going to save this for a little bit, but just give me a minute here to catch up. Just hang on to your questions and I'll definitely take time to go through those. The U.S. resolving supply chain issues domestically and internationally. So there was a lot of terrible things that came out of the pandemic. But one of the things that came out that was good is a complete realization that we had handed too much of our supply chain to a foreign nation who is hostile to us, who has other designs for taking over many aspects. And we saw not only the issue of a pandemic and a virus that was responsible or impacted killing over 1 million Americans, we also see issues with financial markets. We also see issues with supply chain, where as Americans, for various reasons, probably good reasons to be honest with you, we gave up some of those supply chain pieces. And now, since we're being, I would say, decimated at some level, certainly hurt by the fact we can't get things that we need to actually fix the supply chain, I read story after story of enterprising Americans who are stepping up to try to fix this part of the supply chain and this part of the supply chain. It's not the government fixing it. It's enterprising, hardworking Americans who recognize an opportunity to grow a business, make money, and take care of their families, who understand the process of creating, growing, protecting, and preserving wealth, and they're taking it back. And that impact, while it's starting to be felt in some quadrants and not in others, I believe that by the time this thing is done, we're going to see a lot of opportunity that we haven't been able to see until now. And I think that while the pandemic had took a terrible toll on us, I think this is going to be one of the positives that's going to change the landscape when it comes to dealing with future issues economically, financially, and maybe even when it comes to some issues with medical concerns, etc. The return of business competition, that ties into, and I'm going to show you a slide here in a minute, that comes into the supply-demand issue. So right now, you may be sitting there, one of the girls, Kelsey, that works here at the office, she has been waiting for appliances for her kitchen. And there have been various supply chain issues that have stopped that. She's excited that hopefully tomorrow she's going to get them. So pray for Kelsey so she gets her appliances. But the point is that when that supply chain switches, so you've got this demand and you've got this supply, well, of course the price is going to go up. But what happens if you have this supply and this demand? And then you've got two retailers or two wholesalers that are competing on a price. They're going to lower their price. When they lower their price, that's the opposite of inflation. Now, whether it stays down there and how it stays down there, etc., only time will tell. But the return of competition, whether it's for appliances, for cars, for restaurants, for food supplies, for groceries, all of that, once the supply chain is a little bit larger than the demand, is going to create reduction in prices. That's that whole transitory piece, which I'm going to show you again more in a second. I mentioned that the discontinued quantitative easing is a bad, but I think it's also a good. The bad portion is raising interest rates. The good portion is raising interest rates shows that the economy is strong enough to withstand it, to withstand that rise of interest rates. And another piece of that, number 5, rising interest rates for seniors. Many of you have been, and not you, but many of us have been saying, hey, we're looking for a little better interest rates on our savings accounts, our money markets, on some CDs. Well, when that interest rate rises, it will then begin to filter into savings programs as well. And so that rising interest rate for people that want to earn a little bit more money on their money, that's a fantastic opportunity. And it will, as interest rates rise, it will help with that. Whether or not it's going to be enough to make everybody happy or not, well, that's the plus and minus of it. If they raise interest rates too high, that won't make anybody happy. But if they raise interest rates high enough that those who have cash on hand and would like to see some better returns on that, that will be a great opportunity. Number 6, and I think this is one of the biggest pieces of this. If I go back to stagflation in the 70s, what I find is a stagnating economy, inflation, and not very much cash on hand. Today, we are at record levels of individual corporate and money supply, meaning that corporations have more cash than they've ever normally had. Individuals have more cash than they've ever had. So why is that important? Well, because as supply chain issues start to rectify themselves, as products and services and experiences become more positive, you will find that people who with cash will be buying things. And as interest rates get higher and they can find some opportunities, they're going to be investing more, investing differently. Now, you might think, well, goodness, is there anything left to invest in? We're going to talk about that here in a few minutes as well, because there is. Last issue, number 7, the 2024 presidential election. Dependent upon how well the 2022 election goes, and then even more importantly, how well whatever that new leadership is, will have a big impact on the 2024 election. And if we as a nation are serious about fixing these problems, then we're going to look for an administration that is actually focused on fixing problems rather than focused on giving us rhetoric or ideas that they hope would be good, but actually doing things that enhance the lives of American citizens. And I mean everybody, everybody. And so these 7 points in my mind are reasons that I think whatever we're about to experience, how bad or terrible or good it is, these 7 reasons will turn it around. And while we're sitting here today on May 25th? I don't know. Yeah, May 25th, I had it right. On May 25th, we sit here right now and we're like, oh my goodness, it's terrible. I assure you that as we go further down the road, the elections will change our thinking. When administrative policies begin to change, that'll change our thinking. As supply chains open up and we find that we can do some of the things that we wanted to do, our thinking will change. The problem is, and I'm not going to spend time on this tonight, the problem is where we get our information from. And I could spend a whole hour on that alone. But there are some groups that want to put out negative information that focus more on fear. There are some groups that put out positive information that focus more on greed. And then sometimes it switches based on who's in office. But these pieces of information can create a mindset. And that mindset is what you and I have to fight through a bit to be able to see opportunity, to be able to see when we should pull back and when we should move forward. When is it time to create and grow wealth? And when is it time to protect and preserve wealth? And those pieces have a lot to do with how we see things. And so my encouragement to you is to try to get a good balance of where you get information from. We have about 14 sources that we pull information from. Some are more motivated on the positive side, some are more motivated on the negative side, and many of them we try to identify as being right down the middle so we can make good decisions. Because I don't have the luxury of being negative. I have to try to figure out the best opportunities to create, grow, protect, and preserve wealth. I've got to work on that. I have to be thinking outside the box, and I know you do as well. So when we have these conversations, my goal is not to paint a rosy picture, but not to paint an ugly picture either, but rather to identify, here are the dark clouds on the horizon, and here's where the blue sky is. And as we get more and more information, we'll see that sky change a bit to the better, to the worse. We're going to make decisions accordingly. So when we look at those issues, that's how we make decisions. I want to spend a little bit of energy with you on that here in just a second. So let me take a moment. I want to talk about what the equity markets are telling us today. Let me change this for a second. And I'm going to pull up something different. So JP Morgan, one of the resources that we use, and I will tell you just for the record, we use a number of resources, and sometimes we fire somebody and hire somebody new. But one of the reasons we use them is they update their information to us on a very regular basis, and we're able to see things that fit with other pieces we use to determine what we think about what's going on, and to take a look at raw data. The raw data, and I have complete confidence that what I'm getting from them is the raw data that exists from the various resources we pull from. So this isn't a recommendation for JP Morgan or anybody else. It's just how I'm going to use some information to show you what we're looking at here. So let me go to slide 27. I'm not going to go through this whole thing because you don't have time for it, but I want to show you a couple of pieces that I think are critical to this conversation. There we go. So the inflation component. Now, what I want you to understand, and I've actually had several people who said to me over the last number of months, you know, if we have 8.5% inflation every single month, that's like going to be over 100%. That's, you know, that's like Venezuela kind of thinking. And that's not what this is about. The inflation numbers that you're seeing here and the way they're supposed to be reported is looking at year over year percent change. And so in March of 2022, our year-over-year change was 8.5% for the last 12 months, not for the month of March, but for the last 12 months. 8.3 is what the current year-over-year inflation is, 8.3 for the whole year, not for the month of April, but for the last 12 months. And so when we look at this, it's not 8.3 and 8.5 and 7.9 all added together. This is just a figure that identifies where we are with our inflation. Now, one of the reasons I showed you this, I want to take a moment on that, and we could drill down on energy and cars, and I know that probably, I don't say probably, I understand that the inflation number has changed since the 1960s and the 1970s, and it's not showing everything. I fully get that, and I don't disagree with it. It's not. But it is a standardization for all of these years for me, or these months, I'm sorry, to be able to tell what's going on. And that's what I have to work off of. I get it that inflation feels different than that, but from a measurement model, this is nothing more than a thermometer or a speedometer to tell me what's going on. Now, the reason I wanted to show you this was this piece right here that talks about transitory versus sticky or permanent inflation. And so JP Morgan at this current time, their estimate is of this 8.3%, a little more than half of it is transitory or connected to supply chain and demand issues. So in essence, back to what I was saying before about competition, when supply and demand is back on par, it's back to being more normalized, then this inflation wouldn't be as high. So as the supply chain issues are worked out, we will see just by that alone, the ability for the interest rate or the inflation rate, I'm sorry, to drop. Now, having said that, we're still aware that the Fed, I see this piece here, which is still pretty large comparatively. I mean, remember, back here in March of 21, we had a total inflation of 2.6%. So this is still significantly less than the full thing, but it's even less than just the permanent inflation. And how much of this transitory is going to work out is going to be dependent on many factors. It may be that this transitory is smaller than what they've identified, or it may be it's larger. But the point is that as we look at year-over-year inflation, which is what you and I are seeing each day or each month when we get this information, it's not per month, it is year-over-year for that month, comparing March and the previous 12 months, how that fits. So with that in mind, keep in mind that inflation is a problem, no doubt about it, but we're not looking at double or a triple digit inflation. What we're looking at is still single digit inflation. Could it go higher? It could. Something bad happens, that could change it. But the expectation is that inflation is going to be down somewhere between 4 and 5% year over year by the end of this year, which could be right. It may not be right. I mean, analysts and accountants, they predict all kinds of information. And so we'll have to look at this month over month to kind of get a good feel for it. But this is one of the pieces that I look at with you to help you think through or understand what we're looking at. Now let me do the next one here. So this next one, this is 43, is part of the whole issue that we talk about when it comes to allocation. And I know this is a very, very busy chart, but what I want you to understand in this is a comparison. Oh, that's not the one. Where did the one I want to go? That was fixed income. Goodness, I wrote down 43. Apparently, I wrote down the wrong one. So let's go back here. This is not technology. This is me. So let me see if I can fix what I did here. Oh, there it is. I think that's it. Nope, that's not it either. All right, let me go to the very top, pull up which one is the list there. Fixed income, international equities. Well, it should be right in here. See, it just goes to show anybody can do my job. Just got to find the right slides. See all the data that we have to go through? This is fixed. I don't want that. I want equity. So where's the equity? Heat map. Nope. Ah, there we go. That's what I was looking for. Okay, it's slide 61. Wrote that down wrong. All right, so what you're looking at here across the top are the years 2007 through 21, and then what you're looking at here, let's see, is this the year-to-date number? Oh, here's the year-to-date column. So 21, here's year-to-date. This is annual, and forget those last two. We could talk about that some other time. But what you're looking at here is a comparison on various aspects: commodities, cash, fixed income, and what the further down the chart we go, the less performance, the worse the performance is. So at the very bottom of this chart, year to date, small company stocks have been the worst performer. Remember that, that's important in a second. Large company stocks have been next to the worst performer. Real estate investment trusts have done poorly. Emerging market equities or international, developed market equities, international but stronger nations, not the Indias and so on. High yield bonds, asset allocation, which is an equal modeling of all of these. Fixed income, which are bonds, cash, liquid money like savings, and then commodities, which would be more about inflation. So you can see commodities have done about 33% in growth this year. Has to do with inflation. That makes sense. And as I mentioned before, small companies have done poorly at losing almost 20%. Now, if we look at the white box, which is asset allocation, we can see that year over year, so in 2008 it had minus 25%, in 2007 it had 7.1, come down here, 2009 had 25%, 13%, went down almost 1%, had 12% in increase. And I know it might surprise you because you're like, wait a second, how's it going up and down and having positive territory or positive returns? It's because it's comparing it to all the others. And so we can see that asset allocation has stayed pretty much in the center. It's not the top and it's not the bottom. And that's one of the things that we spend a lot of energy on with you, trying to identify how to make your portfolio be best protected in bad situations and then have opportunity for decent returns in good situations. And so by having that, we really have the ability to have a safer, a less volatile ride in the markets and the economy. So consequently, this is where we focus in trying to get people to have the right balance based upon their risk tolerance. Somebody that can handle a lot of risk, we have a more aggressive asset allocation model. Somebody that has a less aggressive risk model, we would be more conservative in their investment modeling. So this particular slide is just to kind of give you a piece of mind, a little bit of understanding in how we try to diversify the portfolios, not putting all of our eggs in one basket. Now, again, don't forget, small company right here. As a matter of fact, if you'll notice, if I were to follow the orange, you'll see that it's a lot more volatile, but notice again, negative right now for the year. All right, let's go to slide 5 now, which is clear back up at the top. There we go. I guess I wrote that one down wrong too. No, there we go. Okay, so I have shown you in the past about how we diversify across large company stocks and international and so on. But this particular part right here, and I could spend probably a half an hour on this discussion just by itself, but I'm not going to. What I want you to understand is this. This is comparing the current price to earnings ratio, meaning that a company stock versus the earnings they pay. And so when it's above 100, it means the stock is overpriced. When it's below 100, it means the stock is underpriced. And so as I look at large company stocks, these down here are large, mid, and small companies. These are value stocks, value meaning that they're not really growth oriented. They pay more dividends likely. Blend, which is kind of a combination of some dividends, but some growth, and then growth, which would be obviously more aggressive in its investment style. We can see that the large company stocks are either of equal value to what the pricing is across the industry, or they're still priced high. But notice down here, small company stocks, remember I showed you it's at the bottom of the chart. Currently, small company stocks are on sale. If 100 is the number, this is on sale almost 30%. Small company value, small company blend it's on sale for almost 22%. And small company growth is on sale for about 13 or 12%. So when we're trying to make money, we try to buy when it's down in price, because you always make your money at the buy. If you're buying a house and you buy it when it's low priced, you've already made money. Because when it goes up, when it increases, because maybe it's like a fire sale, somebody's selling because they have to, it speeds up the process for you to make money. So one of the things we look at when we're trying to determine how bad the economy is, how various sectors and industries are functioning, all those pieces cause us to decide when it's time to make a move and when it's not time to make a move. And so I would tell you these pieces right here aren't bad at all. They're not bad at all. Now let's go back up to corporate profits, which is what I wanted you to see. Now this chart here, which feeds into that other chart I just shown you, it's comparing corporate earnings in 2021 versus expectations in the next few years. And I want you to notice that corporate earnings are on the rise. I want you to notice that this year in last year in 21, they did over $200, and this is earnings per share for the companies, the average in the S&P 500, which represents the 500 largest companies in America. They're not going down. And analyst estimates, based on some of the factors we've already been talking about, see them getting to $225 a share on average, to $250 a share, and to almost $275 a share on earnings per share on average for the S&P 500, those 500 companies in America that represent the largest companies by various industries. So when we're looking at that plane I was showing, I told you that corporate profits are positive. They are. They are. And the expectation is not for them to go down, but to go up. So that means that with what I just showed you a moment ago about small company stocks and various things, as the market has fallen, it's put many of those stocks right at their 20-year average, which puts them at either a good time to buy or getting close to that. So when we look at some of these factors, there are various pieces that we have to consider as we are managing portfolios and working with your investments. All right, I'm going to stop there for a second because I was going to do one thing, but I think I'm going to maybe trade off a little bit here. I want to see. So we got some questions here. Pull this back. Okay, questions on quantitative easing. I gotta make this a little bigger. Sorry, I'm not gonna make it bigger. Okay. Okay. It started with printing money to buy T-bills, then was extended to corporate bills. With QE being stopped, does it mean that the corporate debt is being unloaded or is yet to come? Okay, I think had I not shown you that last slide, I think quite honestly that would have probably spoken into the fact that if corporations aren't making money, they might have to unload to get to that place where they could continue to function. But since they are making money, it's likely not going to be the case. I think that, and it's not like the feds are planning to buy huge amounts of corporate bonds. It's not that huge to start with, honestly. But I think what it means is that they are perceiving it's time to expand their balance sheet to include other things besides government debt. And then on the second one here, oh, just follow up on unloading T-bills, or is that yet to come? Okay, that's just a continuation of that. So what I would say is this, is that that with the item, I want to make that go away. I don't want to lose. Okay, there. I think what this means is the Fed is trying to make decisions. Whether I think they're doing it as fast as I would like or the way they should, I think they're trying to make decisions to set us up to reload for the next time we have a serious recession. Because their tools to help us get through a recession are lowering interest rates, and if interest rates are already too low, you can't do much with that. They don't want to print more money because we have too much money out there in the system right now anyway. And if they continue to buy back bonds, they're just really not improving the system. So by increasing the balance sheet to include corporate bonds and stop buying government bonds, that's exactly what's going to give them the ability to handle a recession when it comes, or to at least make it a smoother landing when it happens. And it may be a hard landing. Who knows? It's one of those things where we look at how the Fed functions, it could be a problem. Now, having said that, I'm looking at the clock. My goodness, I went way fast. I thought I was going pretty fast, to be honest with you. But I wanted to spend a couple of minutes just helping you understand how we make decisions on entry and exit strategies. So this is the S&P 500, what I've been talking about. Again, 500 companies, largest companies in America, diversified among the 11 industries. And so I wanted to show you how we handled a particular time so that you understand that while the market's going down now, or it's functioning volatilely like it is, it's not, to me, the end of the world. I don't like it any more than you do, but what I'm looking for is something that is truly problematic. And so let's see here, we're at, that's 85, that's a little far back, isn't it? Let's go back here, let's move forward to somewhere in this time frame. There we go, that'll work. No, that's 01, I want to take it further. Let's go here. Okay, so I remember this like it was just yesterday, to be honest with you. I remember that the markets were highs. We had come out of Y2K and the market fall from 9/11. I'd seen all that, and we just had great years of growth. And then 07 hits, and I remember George Bush coming on TV telling people not to panic, it's okay. There's this whole question about what mortgage-backed bonds are and so on. And I remember thinking, you know, is this the beginning of the end, or is it something else? We had done well during 2001 and 2, but this was a different deal because the whole question about how strong mortgage-backed bonds were, which sound very safe, was really at issue here. So when the market fell, and let me turn on that so you can see dates. Okay, so right here at this point in time, this is October 2007. And the market started to fall, and from 2007 till right here, this is October to March of 2008, the market was down. So we're looking at 6 months, which is a terribly uncomfortable period because news is trickling out. People don't know what to expect. We're struggling. What does it mean? And so what I was watching as part of our management process, I and our team, was what was happening with the daily activity as compared to the 200-day moving average. And so in March of 2008, the market began to move back up. And as it got closer to this red line, the 200-day moving average, which is taking the last 200 days and averaging the price and creating a smoother line to look at, so you're not looking at all the volatility. It came up and it hit the 200-day moving average. Now at that point in time, enough bad news had come out that I was of a mind we had to pull back. We had to get safer. And so when it came up, I didn't pull the trigger until I watched it turn back down again, because my hope was it was going to continue on up, break through the 200-day moving average and go positive. But when it turned south, I decided with all the information we had, it was time to get out. And so we did. And so while I would have loved to get out up here, I didn't. I got out roughly right in here. But on the plus side, our clients' accounts didn't go all the way down here like this, because I felt like the information was bad enough that we had some things to watch for. And it comes from a lot of the pieces of information that I've shared with you over the last 4 months, that we decided an exit strategy up in here made sense. Now, truthfully, if it had turned and gone back up again, I was ready to get back in. But for the moment, I felt like that didn't make sense. It wasn't too hard to get out of the market, for me anyway. And when I say get out, I mean get more conservative, a lot more conservative. It wasn't hard at all. But here's what became difficult, and that was getting back in. Because whenever you get out, it's hard to get back in, because you usually have to get back in when everything is still not good. There's blood in the streets, if you will, red ink, and people are uncomfortable. And so looking back, I wish I'd had, because we got out up here where we still had a lot of money in play, still a lot of money under management. It would have been so good to take all that extra money and put in down here and ride this all the way up. But I just didn't have the confidence. The information just seemed too crazy. This is June of 2009. By the time we got up here, we're well above the 200-day moving average and well above the 50-day moving average. And we did begin to move into things in the end of 2009, but not a whole lot. And then that later on, so here again, looks like like just this long, but it's not. This is August of 2010. And at that point, we decided to go ahead and go fully back in, which we did. And so what happened, that means, is that we were able to experience a nice run up in that growth. And so that was awesome. And it felt good. And we had a couple of bumps in the road. Here's 2018. We did not pull out, even though it broke below and didn't look as good. We didn't pull out then. I'm glad we didn't, because then from there, it continued on up to here. So there's a 2018 downturn. Here's 2020, the pandemic. Now, I have to tell you that within 10 days or so, we had moved all the clients back to more conservative positions, quite honestly, because I couldn't find any data to give me confidence that the first pandemic in over a century was happening, and I didn't know what to do with that. So we moved all of our clients back to more conservative positions. But by the time we got over into here, we were back in the markets again, which meant we could have some great opportunity for growth. Now, I say all of that to really come to this last piece here, which is, aside from a few of you who've asked me to get more conservative, we still are kind of holding our position, because quite honestly, as I look at this, yes, it broke through the 200-day moving average. We're watching what's going to happen as it approaches this next time. But I'm also looking at all the fundamental analysis. Remember, fundamental analysis tells us what's going on. Technical analysis tells us whether we should get in now or get out now. And so I'm watching all that, and it's probably going to be another 30 to 60 days unless something dramatic happens that causes me to make that decision. Because I feel like we've matched all the portfolios to our clients' risk tolerance. I feel like we've been having conversations with people. I feel like the monthly updates were telling you what's going on. And I would tell you that I'm pretty confident that this is not the moment to pull that trigger yet. Having said that, though, as you'll see in a moment, if you want me to pull that trigger and to get more conservative or get into more cash or get into more fixed investments, you're the boss, I'm the employee, we'll do that. But I'm hopefully showing you here that as I look at this period of time, I'm going to tighten it up a little bit here. I guess I'll have to go 6 months to make that work. Yeah, in time, I'm just going to do this here. That right now, we're just watching this and trying to assess whether or not it's time to make that decision or not. And I would also remind you, let me turn on that balance again. So here's where we are today, clear over here. But notice how high we are compared to pre-pandemic. So when everybody's like, oh, the market's crashing, oh, it's terrible, we're not even down to the top of the market. Not that I'm saying I want to go there by any means. We're not to the top of that market. And definitely we're not to the bottom by any means of what it was at the pandemic. So consequently, while I know a lot of people are anxious and uncomfortable, I don't feel that yet. Now, as always, if I get new information, I'm going to make those decisions. And even more important, if you can't sleep at night with this, then we need to talk about it. Not that I'm going to try to talk you out of it. I'll explain what I think. But bottom line is, if you can't sleep at night, my job is to help you sleep at night. So when you're looking at this information and you're getting your own opinions about it, just understand we're here to help. We're going to help make that happen. Now, I'm going to stop there for a second. I'll take time for questions at the end because I'm going way farther than I thought I'm going way longer than I thought I would, because I had sort of imagined I was going to get through this a lot faster. I thought I was talking fast too, to be honest with you. Not because I was trying to talk fast, but just I had so much I wanted to share with you. All right, so portfolio management options. Here's what you got. One, you could utilize assets or securities that are negative correlators to the overall equities market. And the fact is, with many of our clients, as they get cash available, we've been doing some things that are not market sensitive, just trying to diversify the portfolio and try to either look more towards income or growth in things that respond opposite of the stock market. That's what a negative correlator is. Number two, you could say to me, look, I just want to adjust my portfolio to a more conservative position quickly, like right now or very soon, to protect against further portfolio erosion. Maybe that downturn that I just showed you on that graph is just more than you can handle. I get it. And maybe the bad news and all the other stuff out there is just eating your lunch. I get it. Just let me know. We'll go ahead and make that decision and help you do that. We've done that with one other client in the last week or two. I'd be happy to do that with you as well. Number three, our choice would be we could continue reviewing fundamental and technical analysis and adjust the portfolios to more conservative positions if and when that data supports it, it's time to make those decisions. In which case, you need to know that for all of you who are in managed accounts, we can make that decision, hit a button, and have everything move. And we can do it in one day, and actually in one afternoon we can do it. So the reality is that we have those options at hand. They've not gone away. I'm making a decision to hold a little bit longer, not because I'm hopeful or wanting to believe something that's not true, but rather because the data I'm looking at tells me something different. But again, you're the boss, I'm the employee, we'll do it your way. So now, I really wanted to have like 15 minutes to share this. I don't want to go over 6:30 because I told you we try to keep these at that, but I'm going to just quickly tell you some of the things that we're about to introduce, because I am so excited, have been wanting to do this for the last 6 months, and we're just trying to get everything ready for this. So we've already talked to you about our client-friendly wealth management apps, which I'm going to remind you of here in a moment. And then these update webinars, which I think have helped immeasurably for many of you to kind of have a feeling for what's going on. The only problem I've got with these update webinars, I just need to get many more of you on them, so that way you can hear, because we're getting a small percentage of our clients on there, probably less than 20%. I'd love to see us at 40, 50, 60%. That way you're all going to be up to speed with it. Number three, though, is what I'm introducing tonight. It's our new interactive website. Let me quickly pull that up so you can see it. Because one of the things that is so essential is your ability to see information and to access it easily. So first off, on the new website, it is tablet and even phone friendly. So you can access the app on your phone, on your tablet, or on your computer and see all the information. With this, we've got things like client login here. That's not the one that's set up. This right now, what you're looking at is the demo version, which is going to be opening up here hopefully within the next week. But on client login, here's how it works. Click the client login, and I know that many of you have struggled with this. You're like, I got to hang on to all this stuff. No, here's what happens. You want to go to your eMoney account, your wealth management dashboard, you can log in right here. You want to go to your investment management dashboard with us, you can click right here on All Bridge. It'll take you right there. You sign in, or if you've got your password saved through a password form manager, that'll take care of it. You want to take a look at your risk score and update, right there. You want to look at your financial life plan, which has not only the facts, but also the feelings and the goals for your return on life. You can go right there. So this login place right here makes it so you can get to all of your accounts easily, all of your information easily from the website. Again, on your computer, on your tablet, or on your phone. And then the next thing I'm really excited about, and because of time, I'm not going to drill down on everything, but I'm going to tell you that, for instance, again, this would be another way you get your client logins. We've got a bunch of planning calculators you can access if you want to just see some different things. Complimentary consultations for your friends if they'd like to, that'll be there. These 6 areas here, they talk about what we do when it comes to working with entrepreneurs, with individuals and families, and with retirees. These 3 here, they're going to be finished up here within the next day or two, but what they will do is this one here, while it says contact us, it's not going to be contact us, it's going to be events. All of our events, like this webinar, other events we've got coming on, they're going to be held in here. Plus, we're going to keep the last 3 of our investor update webinars right here in the same area. So you can sign up for the one that's coming up, or you can look at the last one or the last 2 if you want to get refreshed on what we talked about. It's right there. And this one here is going to say our educational resources. And on the educational resources, we're going to begin putting all of our educational content on here. We're also going to put a blog on here for updated information on many of the pieces we work with, our own thinking on things, so you can actually see that. And this would be stuff that'll be happening initially, it'll be weekly, but then it'll begin to happen more and more often, so that you could even be given updates on how you're going to be able to see information and catch up on things. We're also going to put together a YouTube channel, which is going to have literally hundreds of videos that are going to talk about all the things I talk about with you. I know that when we're in meetings, I'm running through things and you're like, oh yeah, I remember you talked about that last year or last meeting or whatever. The videos are going to be there for all of your education. So you can go and see, well, how do we decide to break up a portfolio for a more aggressive, more conservative model? How do we handle retirement planning? How do we handle long-term care planning? How do we handle estate design or tax management consultation items? And then break down even deeper into, I talk about the 8 circles, cash, bonds, equities, and so on. What do each of those actually really mean? And then how do we drill down? And then the 10 concepts that we talk about, how do each of those work? And instead of you having to try to hang on or write notes to make it so you can actually just go watch the video and then be refreshed on what we're doing, so make your questions even better. This is something I've been wanting to do for a year or more, but we just didn't have everything ready for it. But we're putting it together now, and I am so excited that we're going to do that for you. And then down here, you want to see the team. So here's the team. This is Alex. Here's Brent. Cher, we can talk to her on the phone. I don't know who this guy is. Here's Kelsey. She takes care of new business. Here's Paul. Paul helps with investment back office issues. And there's Stephanie. She's helping with keeping everything running in here while we're all trying to do what we're doing for clients. And there's more detail on all of this, but I am so fired up about this piece being sort of the centerpiece to what we're going to be doing going forward. And by the time we get to the end of the year, let me flip back over here a second. 6:33, I got to hurry. So as I mentioned before, the new interactive website, the phone and tablet apps will be part of that. You can do that. Educational videos for family and finances, because we don't only, as many of you know, we don't only just talk about finances, we talk about return on life, we talk about family issues as it pertains to each of you, because as I've been doing this for over 3 decades, I've learned you don't get much closer to people than when you get near their wallets. And so we end up talking about a lot of personal things, and a lot of the stuff that we share, not about you particularly, but how to talk to family about wealth management issues, how to help kids become more involved, how to deal with estate design issues, how to deal with various risk issues. We're going to cover all of those pieces, not just the facts, but the feelings that go along with it. And then our blog, and I wrote blog, but really this is going to become podcasts, because I've got so much from 10 years of radio that we're going to turn those into podcasts so people can have those and start releasing those on a daily basis as well. And then the YouTube channel, once we get to a certain number of videos, the website can't handle, I don't think, more than 12 or 15. We're going to have a YouTube channel that's broken up so people could actually go there and see things as well. And there's more. Again, time's not going to permit tonight, so that's part of what I'm excited about. So diversification, I've shown you this before. As I told you a moment ago, we're going to have videos on each of these items and what they mean, how we work with them, how it fits together for your portfolio management, how to decide how you should diversify, how we handle cash reserve needs, what your income to growth ratio is, probability versus surety, tax management, consultation ideas, risk tolerance management, diversification, how to use dollar cost averaging. Even if you've got a ton of money and you're trying to figure out how to use it to lower or improve your risk tolerance. Asset cyclical management, what does that really mean? Waiting and waiting, why do we even say such a thing? And then how we maintain entry and exit strategies. And instead of rushing through like I did tonight, which I didn't really want to, I'm going to actually have some time where we're going to share so you can see in more detail what each of those pieces are. That's what the website and the videos are going to make possible. Obviously, the apps that we use, those are the 4 that I showed you across the top there. These are so central, and I can tell you our clients that are fully using them, they are loving it. If you're not fully using them or you're just using a couple, please let us know. I wouldn't spend the money to make these available to you if I didn't think it wasn't going to help, because it really is critical. And we're going to do videos on what each of these do as well. That's going to be another one of the pieces. So questions, let's see here. Did anybody have their hand up still? I don't know, let's see. Question, no question. Nope, that's good. Okay, I take it there's no questions right now, so I'm gonna move on from that. But if you have questions, feel free to email info@franksoffice.com, and we'll be happy to get back with you on those. And additionally, I would tell you that we are going to, let me just check one more thing here because I see something. Oh, there it is. There's a question. I thought there was a question. That's not a question, that's a fact. My Chick-fil-A is waiting for me. Although I don't know if we have Chick-fil-A tonight. But you're right, I'm getting hungry. I don't know about you. Oh, that's one of the things we're going to talk about too, but I'm not going to tell you tonight. We've got some stuff coming on that item as well. So, all right, anyway, really, my goal is to make it so that when we move forward with you, that you are getting to have all of the experience, all the education, all the information that you need to make it so you can have peace of mind as you're managing money and creating, growing, protecting, preserving it, but also that you can have confidence that we are on top of it, that hopefully you all believe us to be honest and competent. I'm sure you believe we're honest, but I would say the purpose of the videos is to really help you understand our competencies to make it so you feel comfortable to go forward and make new decisions, make better decisions, make different decisions. That's what the goal of this is. With that in mind, the next monthly update for your financial journey is going to be June 21st, 2022. You know what I didn't tell you? I had a couple people ask. So the reason we didn't do it, this is next, that's the 3rd Tuesday of June. The reason we're doing this on Wednesday is because my son, Wyatt Douglas Reynolds, he graduated last night from Mainland High School. He walked the stage, got to do that, and got pictures with him. We're going to be sending out a post for that as well. And he was magna cum laude, which is really impressive. I would say to you that his sister, she was summa cum laude, so I think that she deserves that. And for those of you who don't know, Stephanie Jameson is my daughter, and I'm so excited that she's here. Brent Jameson, her husband, who is my son-in-law, who is an advisor in training, he's also joined us. So we've got a lot going on here, and I am so excited about how things are really coming together from this last year or two. Looks like we got this. Oh, thank you, Sonia. Sonia's actually, she's like, you get my Chick-fil-A and congrats, and thank you, Sonia. I appreciate that so much. All right, so in closing, I think that's it. In closing, we have reviewed what we believe to be true so far, the good, the bad, the ugly, given you a market and economic review, which I apologize I'm going over, but I was trying to get through it all. I'll try to get better next time. Potential exit strategies and how we're going to work on that. And while I showed you a major index, the S&P 500, we do that same thing for individual securities and industries as well. Hopefully the portfolio management diversification options are making sense to you. Can't wait to show you to open up the new website, which hopefully will be this week or next, and then start with all the other things that we're going to be doing with that. And then I look forward to seeing you at our next investor update. And as always, please invite your friends. I know if you're nervous, so are they, and let them know they are welcome to attend. No high pressure, no nothing. We're here for you as well as we're here for them. And so with that, I think I'm going to go get some dinner. Oh, I see a hand. I'll just make sure that I haven't missed anything. Nope, looks like I haven't. We're good. Oh, there's a hand. I think we got that already. News, did you get your question answered? I'm giving you just a second here. If you didn't, you can text in the chat and I'll watch for it. Anyway, with that said, as always, I am so honored to serve you, and I mean that. Our whole team is. We could not do what we do without you, and hopefully we're bringing some real value to your life as well, because that's our goal here, is to make sure you're getting your needs met and that we're helping you to create, grow, protect, and preserve wealth for you, for your next generation, and in some cases, maybe even a multi-generational approach. So with that all in mind, I am going to go ahead and close out. Again, if you have any questions, feel free to email us, share at Frank's office, or you can email me directly, fr@Frank's office, and I would be more than happy to talk with you then. So have a fantastic week. Have a great Memorial Day, and I will look forward to talking to you all soon. Have a great evening. God bless.